All right, everyone. We have our next panel coming up, which, as I mentioned, is the Stablecoins panel with Ash from the Ethereum Foundation, who's leading stablecoins from the Ethereum Foundation sides. We have Haonan Lee in the middle, who's the co-founder and CEO at Codex, the self-proclaimed special forces of Ethereum stablecoins. And we have Benjamin from CAP, who are building verifiable infrastructure for stablecoins. So please, Ash, take it away.
Thank you very much. Is that on? Yeah. Thank you very much, guys, for coming today. I hope everyone's had a good time in Argentina, eating plenty of steak and drinking some mate. So thanks, Haonan. Thank you very much, Benjamin, for joining me today. I think we've got a pretty cool panel up, and I think we'll jump into it here. So a little bit of a high-level one to set the tone. I want to know what you guys think is working in DeFi today, what's not, and generally what's working on Ethereum and what's not, and just sort of elaborate as to what we need to unblock there to onboard the next trillion in capital.
I think, well, thanks so much for having us, Ash. It's great to be here, and what a wonderful country and what wonderful meat and wine they have here. I think what we're seeing primarily work in DeFi, at least for the customers that we're handling, that we're seeing on the ground, is this kind of low-risk DeFi concept, I think is resonating a lot. What I mean by this is not some crazy levered, wrapped counterparty risk on counterparty risk on counterparty risk, but rather something that's easily understood. It's very clear what the risk the user is taking is. And the yield is okay, right? But it's not some crazy number that's going to get you rich. But it's a yield number that allows you to put assets to work. And I think that's sort of what we're seeing resonating in the market.
Yeah.
Well, first of all, thank you to you for hosting this and for the EF for organizing a great conference. From our point of view, there's two sides of DeFi. There's managed DeFi, and then there is open protocols, right, that use smart contracts. What has always caused user losses has been managed DeFi. When you trust a team to make decisions over people's money. This can be a vault product. This can be a DAO making decisions over the parameters of a lending market. In general, humans getting in the way of DeFi. The other side is open protocols.
Do you want to dig a little deeper there into what happened the other day with Stream?
Well, yeah, if you look at what happened with Stream, or it's all kind of like very foreseeable because it happened last cycle with Celsius and with BlockFi. Humans make mistakes, and smart contracts are supposed to, improve the trust assumptions on humans. Yet every cycle we seem to fall back on the 20% APR. Deposit your money with me, and I'll do something with it. The reality is, if any of these teams were good hedge funds, they wouldn't be stablecoins. They would run a hedge fund in Wall Street. And so I think we should really stop trusting these teams to do strategies on behalf of users because they're not regulated, they're not covered. And it's not quite clear what the risks are that people are getting into.
I guess they're not even using the basic stuff like Nexus Mutual, right? That's
exactly. I mean, first of all, Nexus Mutual is a wonderful thing to be using. But even then, I just don't think we should be trusting humans in the first place. So the other side is open protocols. So look at things like Morpho, like CAP, like Ethereum, for example, where you have immutable rules that all actors must abide by and are executed by smart contracts. Because smart contracts don't fail. They don't, as long as you write them well. They enforce rules coldly. There's no calling up a smart contract and asking it not to liquidate you. I think if we were to focus more on smart contracts and less on human dependencies, I think we can make DeFi a lot safer.
I think connected to that, there's this abuse of the word stablecoin when it comes to these strategies. If it's just a hedge fund, but the way you get to be an LP in this hedge fund is that you hold the stablecoin. It's kind of an abuse of the term.
False premise. It's
sort of a false premise and sort of misleading, I think. I think, we should probably adopt some other vocabulary like yield coin or something.
I think everybody stopped using stablecoin the moment Genius Act passed. You should track the changes in UIs. Maybe you can look at PRs. But as soon as Genius Act passed, Ethena is now a digital dollar. I can't remember the last time Sky has said stablecoin. We've never called ourselves a stablecoin. I think we say digital dollar as well. Because you're right, like you have all these like complex like money markets that are set up on top of stablecoins, which is actually very beneficial because if you have a receipt token that's stable, now you can loop it on Aave, etc., and all these things that you were mentioning are not so quite safe DeFi.
Yeah, yeah, absolutely.
How do you guys, so that's the broad level, how do you guys see what you're building with Codex and then Cap fitting into this world, and a little bit about where you're going as well?
Yeah, I think what we see is that, well, Ethereum is the dominant place where most stablecoins are today. But I think you see lots of challengers on the horizon in the form of Tempo and ARC and other folks. And our mission at Codex is to make sure that Ethereum continues to be so dominant in stablecoins. And we continue to innovate at sort of the very cutting edge of what's going on here. And I think in particular, we're focused on how can we make this barrier between fiat and stablecoins disappear. Now, traditionally, this is not something a chain team focuses on. This involves a lot of work that traditionally is out of the kind of circle of competence of a normal chain team. But we are not a normal chain team, and so that's what we're focused on today. Our goal very much is to make stablecoins make sense for not only these sort of crazy edge case countries and situations, but rather make sense for a kind of mainstream audience, including many mainstream businesses. And if we do that, then we'll have fulfilled the oldest dream in crypto, which is this dream of a global electronic cash system.
Well, I'm an Ethereum maxi, and that's why I'm building on L1. I think it offers the strongest guarantees for users versus, let's say, other chains. Specifically, what we're doing within the context of smart contract protocols that are meant to protect users is we've imported this primitive from TradFi called surety bonds, which are very similar to credit default swaps, and we're using it to protect our users from the risk of the yield generation that happens at our protocol. So at CAP, we have this digital dollar that on the back end has several regulated institutions like Susquehanna, like flow traders, etc., constantly competing to make yield on our dollar. They're borrowing via private credit, and they're generating yield on the dollar depending on their ability to generate yield in that market condition. But before they can come in, they need to provision a surety bond, which is, again, similar to a credit default swap. And if they were not to repay, we can use smart contracts to automatically slash them and recover the loan for our users. So using smart contracts, we're able to recreate that on Ethereum.
What are they willing to pay for that credit at the moment? Like and largely speaking, what are the big risks they're taking with that?
So they're willing to pay the overarching unsecured premium for the dollar. And so we're pretty much tied to the overall capital markets. So if you look at Wisdom Tree and Apollo, which do unsecured lending, it's around 10 to 15% depending on the market condition. What we do is we give some of the yield to stablecoin holders that are taking a secured position. So they're getting, let's say, 50% over the T-bill rate. And we're giving the credit spread to ETH holders, which is quite interesting for them because the difference between the unsecured and the secured dollar premiums is greater than the unsecured premium for ETH. And so you're able to give ETH guys a great bond on Eigenlayer.
Do they know, the holders taking this position, underwriting it, do they know the risks they're taking?
Yes, yeah. So for us, just like you were saying, we try to keep retail in the safest position. So US dollar holders are completely protected by these Eigenlayer assurances that we've built and Symbiotic. The ETH guys that are underwriting the institutions are institutions themselves, right? They're not retail that can come in and underwrite another institution. They have to have at least $5 million, so qualified investors.
And so the underlying credit exposure is like U.S. corporates or?
Yeah, so it's, today I can name some like Susquehanna, like Flowdesk, Flow Traders, Amber Group, these kind of folks.
Yeah, I think we're seeing this emergence of new sources of yield as well. I think on the payment and stablecoin payment side, you're seeing a new source of yield, which is effectively the pre-funding of stablecoin payments globally. And various PSPs need a balance of stablecoins in a certain fashion, and you can charge them a yield for it. I think this direction is where the future is, right? Where the yield is on the other side of some productive activity. I think the kind of days of vintage DeFi where it's a DEX token that the source of the yield is the governance token of a venue that you can speculate at. I think that's a tired and old game that is not super interesting.
Yeah, with the risk premium paid, we need to be beating the T-bill, right? That's quite competitive now.
And most protocols don't beat the T-bills. If you look at the average lending market today, the average dollar in a lending market in crypto is not beating the T-bill rate, which is insane.
Yeah, there's no chance to sort of hedge your staked ETH and earn anywhere close to the T-bill yield, right?
Oh, and now we stake ETH, but like I'm
No,
saying
no,
the
just
dollar,
yeah.
yeah. ETH is doing great.
I think the design space has just broadened out a lot, right? So like under a maybe antagonistic American administration like the Biden administration, it's very difficult for crypto systems to plug into the world of atoms. And when you don't plug into the world of atoms, you have a much smaller set of possible yield opportunities. And you end up doing these kind of like empty casino games that don't go anywhere. But I think now the design space is much more interesting. Where are the places where crypto can catalyze more economic activity in a productive way and then pass on a piece of that productivity to stakers? I think that is the prompt that we should all be thinking about.
Yeah. October 10, right? You got exposure there in this market to these market makers, these funds that you're talking about, these names. There's speculation that there's been a blow up in that market specifically. Traditionally, where have they been sourcing the credit that you're supplying them? What do they like about your product versus where they're getting it from? And the risk exposure you have to these days where you have cascading liquidations. How do you think about that?
That time wasn't fun.
What's that, sorry?
It was not great. We've had 3 major market downturns, including the one we're having right now, since we've launched the protocol. But nobody has defaulted. There's been no slashing events. You have to remember that these guys that we're working with are regulated financial institutions with audited financials that they get released every month. It doesn't matter what happens in crypto, like because the restakers or the surety bond holders that are underwriting the borrowers, they're underwriting a credit entity, right? They're not underwriting a strategy. So even if Flow Traders loses on the strategy that they're deploying with the borrowed funds, they have $14 billion assets under management, right? With a guarantee to repay the loan to the person that's underwriting it. So as long as there's like no systemic risk across all of finance, then we shouldn't see, like Flow Traders is not going to go bankrupt because ETH went down, right?
Yeah. Yep. Makes sense. I guess like there's actually a big push at the moment. You have S&P Global coming in. There's the ratings. Obviously, Sky, they would have had to pay for that to bring this legitimacy to the space. This is going to need to happen more and more, right? I think Credora the other day, they've announced that they're going to do low-risk DeFi ratings. Again, there needs to be funding for this stuff, but to build out these risk frameworks, like this is core to how financial markets work today, is that there is an education around risk and risk management. And probably increasingly so, we're seeing that in this environment. You have participants that understand it, that have played in it, high sort of frequency guys and just generally people that have been close to the EVM. But in educating this next chapter, we're going to need, to bring in the capital, more risk terminology, frameworks. Like where would you start there in terms of what's the number 1, number 2, number 3, big risks that you guys see and ones that you would point people to?
I think the biggest miscalibrated perception of risk today are largely in traditional markets. So let's start with the S&P. So the S&P is viewed as sort of this risk-free place to put money if you don't know what to do with it. But I think what is underappreciated is the growth of the S&P in the past 2 decades has been because there's a lot of large tech companies with zero marginal cost and no capital intensity, no CapEx. It just keeps on growing to infinity. You don't have to put money in the ground. It just keeps on growing. what we're seeing now in the AI era is actually that these companies are transforming into capital-intensive, positive marginal cost businesses. Each incremental use of the product costs something. Each incremental user costs something. And so I'm not sure that's widely understood, that when you buy the S&P index, you're putting like half of your money into one single correlated bet on AI. So then there's private equity and private credit, which have their own problems. And I'm a little skeptical generally of this democratization thesis, where you're basically offering these products now to retail. Why are they being offered to retail now? Let's think about this for a second. Like in the 80s, when Kravis was doing this by himself, he was keeping the exposure. Why is that? Because he was making so much money. Why is it now that when institutions don't want private equity anymore, all of a sudden we're trying to democratize access to retail? Is this democratization, or are you passing on to the next bag holder? I think those are where the most misunderstood and miscalibrated risks are. And to the extent that we as an industry enable that under some kind of tokenization subthesis, we should be very careful, I think.
I could not agree more with the private credit side, for example, because we have all these large firms that are bringing on their private credit tokens. I won't name names, and they're having them be used in DeFi. Meanwhile, all of the private credit funds are not blowing up, but they're having severe losses due to First Brands and Tricolor, because human decisions again ended in losses. We don't need those firms in DeFi. We don't need those firms on the blockchain. We can use smart contracts to build a better finance. That was the original idea.
Absolutely, and I think these kind of new exposures, right? New products that can be built because of crypto properties are what I think is most exciting. I think if you stick an existing asset that already exists in TradFi and you go, okay, now it's on chain, you're almost definitely adversely selecting, right? Like, what is new? What is new is that there's a new set of bag holders. That's what's new. And I'm just very skeptical of that approach. I hope I haven't offended anybody in the audience or you, Ash, but that's my view.
Not at all. Certainly agree. So, we are creating, these new products, but a big part of this next chapter, right, is distribution, and this is something traditional finance has very clearly routed. I know, for instance, even on the CME, when they go to pitch a new derivative, they have to find buyers and sellers of it, and often 90% of the markets that the CME even launches are dead within 12 months because they can't find liquidity and distribution there. I guess what I'm asking specifically on your front, and then Cap, how do we go from now to far larger distribution? How do we understand within these environments that are traditionally, they're hard to understand who your user base is? How do we have a closer interaction with those customers? How do we start designing for them, with them? There's still an immense amount of discovery to do, but a lot of this comes from market research and understanding the problem space. So, with your side, I guess like some of the most successful sort of stablecoins and stablecoin execution environments have been because they're on the ground integrating with merchants, etc. And then, on your side, Benjamin, how do we take this today and onboard far more people that want exposure to your product?
Yeah. Not to sound cliche, but I think like listen to the damn customer, right? What does the customer want? I think, for instance, there's so much to build here, right? The first thing we think of is there's really no efficient way to hedge stablecoin FX exposure today. And I think those instruments are actually relatively straightforward to build. Read a Robert Shiller paper on perps and go from there. I think the distribution question is interesting. So you work with a large TradFi partner, and they quote unquote bring distribution. If they bring if all it is that you are supplying a chain and they bring all the distribution, why should they work with you? It's not clear why they should work with you. So I think what is most interesting for us is the development of sort of these frontier products on the very cutting edge. These new needs that are emerging because of a shift onto stablecoin rails. We don't want to kind of ride off the coattails of some large existing institution.
Yeah, I think I agree with you. Listen to the customers. Sometimes we build products and don't really think about who's going to use them because we like building cool things because we're nerds, we're crypto builders. For me, it's the regulation, right? I think we need robust regulation in each avenue of crypto in order to get full adoption, in order to get these TradFi players to come in. If the the election shows us anything.
Is that something, just to dig in on that, is that something you hear, or is that, yeah, where does the regulation?
See, like
Okay.
before the election, cap, we were leveraging, MEV and market makers to borrow from us and, to do the same thing. After the election, we're working with publicly traded companies and the world's largest HFT firms. And that would not have happened if it wasn't for the election and the change of regulatory outlook.
Yeah, interesting. Okay, take it a bit more high level. I think like we touched a bit on it. This is about reinventing finance as well as transitioning it into a more efficient environment. But we're talking about creating something better, and I think that's sometimes lost in this modern, version of DeFi that we need to, win very much today versus like continuing to push this broader vision, right? And so, like, we're still a very long way off a consumer being able to hedge their fuel exposure for the year, to lock in a price and, create a budget around that, right? That's something to me that I would love to do. I'd love to buy 5,000 gallons of fuel today as a consumer and know exactly what I'm paying, pay a subscription rate, to manage the margin of that product, have some interest, credit product attached to that, all on the back end, and then ultimately get exposure, pay a small monthly fee to know what I'm getting for my fuel, right? So that we can do that now, and we can create these products. How do you think about that? The broader vision. How do we ensure that the builders, yes, today commercialize and ensure we generate revenue, but also remember where we're going. Sometimes we get lost in the weeds of it. I'd just be interested to sort of see and end on this note.
Yeah, I think it's a balance. I think, if we produce some sort of ivory tower, super cool thing that Ben and I enjoy talking about in a corner here, but no user on the planet ever wants to use, that's probably doesn't bode well for our companies. I think we got to be pragmatic. I think it's also a progressive thing. So what you were seeing happen first is stablecoins, which makes sense because everything else needs to be built on top of some sort of payment stack. Let's say you wanted a thriving corporate credit market working on Ethereum and Codex and blockchains generally. Well, what do you need for that to happen? You actually need corporates to be transacting on stablecoin rails in the first place. And what happens when you have that occur? Well, you get a really interesting data source now. Imagine that you have, privacy needs to be implemented, obviously, but imagine you have an on-chain record of every transaction that this corporate has made in the past 2 years. What kind of underwriting could you do? You could do a much, much more sophisticated form of underwriting than is currently possible in traditional rails. You could lower the risk of these credit instruments because you now have more information. That stuff, I think, is very, very exciting, but it's probably too early. I think if a company were focused on that today, it would probably die.
Yeah, exactly. And I think the way that traditional companies address this is they have their R&D departments, but I guess today we don't have the capital allocation to justify that as sort of the leading indicator to show the market where this is going and to buy into me, today, but ensure they still know that this is a visionary entity. Maybe for me, there's just not enough of that today. Like, where are we going? That I feel like we've lost that, but yeah, keen to hear.
Yeah, I think it would be great if there weren't so many tokens. I think if this industry had less tokens, we would be more advanced because founders wouldn't make money so early and they wouldn't leave our industry. Right? It happens so often. People raise at insane valuations, they OTC, and they leave and you never heard of them again. That's important because overall, DeFi will be the future of finance. It's written in stone. Technology always overcomes. And if this is better than the old model, which it is, it will become the new model. The question is how fast. And I think if we nurture a culture of building good products and not nurture a culture of cashing out and just leaving the industry, then I think we can advance much faster.
I think the cash out plays are very, very short-sighted. I know like we're headed into a possibly a bear market.
Please
and,
don't say that.
Okay, I take it back. We're clearly headed into a bigger bull market. But okay, well then my sentence doesn't make sense.
Go ahead.
All right, so like it's the price. Some of the price is going down, right, guys? Like let's be real. So some of the prices is going down. People may feel a little like, like is this stuff even real anymore? It's really real now, right? It's not like previous cycles. Like you still have the Treasury Secretary of the United States talking about stablecoins all the time. Like it's real now to an extent that was not the case before. And the founders that Ben are describing who like just want to get in and out, okay, go do that. I'm sure they can buy a nice house somewhere, but it's incredibly short-sighted. There's a massive, massive market opening up here, trillions and trillions of dollars of value. And, we just need patient builders who are also pragmatic and actually listen to the customer. That would be my take, Ash.
Yeah. It's going to be a grind, but I'm glad we've got characters like you, Benjamin, and Haonan building this future. Thank you guys so much. We'll end it on that note. Julian, amazing. Thank you for putting today together, DeFi Today, and I hope to, see this event, grow out over time and create this forum. Hopefully, we bring more, bankers together to see where we are going and what we're pitching. So, thank you guys. I appreciate it.